So imagine shrinking your entire operating fleet by 10%, running way fewer ships, and then somehow posting an 11,600% jump in net income?
Which is just borderline absurd until you look at what they actually do.
Right. It makes no sense on paper. Welcome to Earnings Unscripted. It is May 21st, 2026, and today we are unpacking Q1 for Star Bulk Carriers, ticker SBLK. They just dropped their numbers, and just as a quick reminder, this is our personal take and definitely not financial advice.
Yeah, please don't buy cargo ships based on what we say. But, I mean, if you look at their actual business, they haul dry bulk commodities, so iron ore, coal, grain, and right now they are structurally printing cash.
No, completely printing it. Just looking at the top line, voyage revenues hit $281.2 million, up almost 22%. Earnings came in at 52 cents a share compared to exactly 0 cents this time last year. Operating income just exploded up over 360% to $70 million.
Well, that is exactly what happens with extreme operating leverage. Like you said, they dropped 15 ships from the fleet year over year, but their daily rate, the time charter equivalent, that skyrocketed. It jumped from roughly $12,400 a day to over $18,400.
While their actual daily operating cost per vessel is basically flat, right? It sits around $5,000?
Yeah, just a little over $5,000. So that extra $6,000 in daily rate they're charging now is almost pure margin. It just free falls straight to the bottom line.
Which totally explains why the tape looks so volatile today. The stock spiked immediately after the release yesterday, gapped up this morning to test near $28, and then it sort of faded down through the afternoon.
I mean, it gave back 3 or 4% by the close. Yeah, typical fade. But it still finished the whole reporting cycle almost 5% higher than its pre-earnings baseline. Investors are really starting to price in these geopolitical tailwinds.
The geopolitics. Yes, that is the weird paradox here. Most consumer companies right now are complaining nonstop about supply chain nightmares in the Red Sea. But Star Bulk's management sounded incredibly comfortable on this call.
Because disruption is a commodity for them. It actually tightens the whole market. When you have tensions in the Persian Gulf and the Red Sea, oil prices go up. So ships physically steam slower to conserve fuel.
And when the global fleet moves slower, it chokes the total supply of available ships.
Exactly. Artificial scarcity. The capacity tightens, spot rates go through the roof, and they literally profit off the friction.
Wow. Okay, there is so much more hiding in this filing, though. They are outright refusing to order new ships. They have a massive shadow M&A contingency on the books. All right, let's get into the details.
Let's start with that shadow M&A contingency, because I think it tells you exactly how capital actually moves in this sector. This was not in the press release. They did not put it in the earnings deck. An analyst literally had to corner management during the Q&A to get it out in the open.
They buried a multi-million-dollar acquisition?
Almost $500 million. $470 million, and it is a completely locked-in fixed-price agreement.
To buy 16 ships, right? But from a competitor.
Yes, but only if that competitor, Diana Shipping, successfully takes over another company called Genco. It's totally contingent. Star Bulk is basically waiting in the wings. If those merger dominoes fall, they step in and swallow the 16 ships at a prearranged price.
That is like playing chess on someone else's board. They are letting their rivals take on all the merger execution risk, and then they just sweep in to pick up the loose assets.
It acts as a pressure release valve for Diana's balance sheet, and Hamish Norton, the president, was surprisingly blunt once he was actually asked about it. He just said, yes, the agreement is for a specific price that is fixed at the moment.
It feels so completely different from how tech companies do M&A, where everything is highly publicized and hyped up. Here it is just quiet, ruthless asset trading.
Well, ships are basically just floating steel derivatives. You're trading capacity. And this whole proxy strategy makes perfect sense when you look at what they're doing with the shipyards, or rather what they are refusing to do.
Right, because normally when a company is just flushing with cash, like pulling in $70 million in operating income, the natural instinct is to build shiny new assets. You want the newest tech.
Usually, yes. You expand the fleet. But the CEO, Petros Pappas, basically drew a hard line in the sand. He explicitly stated the idea is not to continue any further with new buildings until prices start falling. Shipyard inflation is just way too severe right now.
So they're going on a buyer's strike.
Effectively, it is brutal capital discipline. Instead of locking up cash in overpriced new builds that take 2 or 3 years to even hit the water, they are just harvesting the current spot market. They spent roughly $38 million repurchasing their own shares this quarter alone.
Wow! So they're shrinking the float, but they are also returning a ton of cash. The dividend jumped to 50 cents a share, which is a huge leap from 5 cents a year ago.
Oh yeah, Pappas even put a flag in the ground. He is targeting more than $3 per share return this year, assuming the freight curves hold up. But, and this is where it gets a little risky, there is a vulnerability in how they're generating that cash.
Because the actual fleet size is shrinking. You mentioned earlier they dropped 15 active vessels year over year.
Down to 135 ships, yes. And that is the underlying mathematical risk here. This incredible top-line growth is entirely rate-driven. If that geopolitical gridlock unwinds tomorrow and those daily spot rates drop back down to historical norms,
then suddenly everyone realizes they have fewer ships to actually carry the volume. The leverage just cuts the other way.
Exactly. High daily rates are masking a smaller volume footprint. Plus, they hedge those rates with forward freight agreements, these financial swaps. But because they do not qualify for hedge accounting, every single swing in the derivative value flows straight into their operating net income. They took a $3 million unrealized loss on them this quarter.
So the earnings will always look a bit erratic depending on the day they close the books.
Totally. It injects a lot of financial noise into a business that's already at the mercy of global supply chains.
Okay, but for now, they are riding the macro wave perfectly. So where does this leave them heading into next quarter? If they're just sitting out the shipyard game, are they basically waiting for the weather to change?
Literally, yes. I mean, they are forecasting climate patterns like it's a balance sheet. Pappas actually laid out this whole El Niño thesis. If the northern hemisphere gets a severe heat wave, air conditioning demand spikes, and suddenly you have a massive surge in thermal coal shipments just to keep the power grids alive.
So they are effectively trading the global thermostat?
Pretty much, but the weather cuts both ways. You get a drought and the grain trade dries up, or water levels drop at the Panama Canal and literally choke off the transit routes. It is highly volatile, but management believes that kind of friction just keeps global supply constrained. Pappas said on the call they are actually positive for the next 18 months.
18 months is an absolute eternity in shipping, especially for a business balancing on, well, unpredictable weather and war zones. Oh, but speaking of modern risks, did you catch the AI disclosure in the fine print?
The cyber audit? Yeah, that was a fascinating detail to find in a dry bulk report.
Right? I did not expect to see AI chatbots popping up here.
Well, they are integrating AI into their daily maritime ops to monitor the fleet, but they immediately had to bring in external risk assessors because apparently marine cyber attacks are a very specific, growing vulnerability. You do not want a hacker spoofing the navigation on a 100,000-ton Capesize vessel.
It is just such a surreal contrast to me. You have these giant steel ships hauling dirt and coal across the ocean like they did a century ago, but the C-suite is stressing over artificial intelligence and financial swaps.
It's a very weird collision of centuries, but hey, as long as the ships keep moving slowly and the spot rates stay high, I guess the dividend is safe.
Fair enough. I think we'll leave the global weather forecasting to them. Let's wrap it up here. Thanks for breaking it all down, Miro.
Anytime. Catch y'all next quarter.
If you want these earnings drops to just show up in your feed, go ahead and follow the show. Just as a quick heads up, we do use AI to help generate this podcast, mostly for the heavy lifting, like boiling down those dense 50-page SEC filings, so we can focus on the actual story. If there's a ticker you want us to dig into next, definitely drop an email to earningsunscripted@datamadness.ca, or just grab the X link in the show notes.
See you next time.